Hello, good evening, everyone. Good evening from the UK, from wherever you're watching today. It's good to be back here. So happy to be here again. How have you been? How's it been with you? How was your weekend? Today is Monday. I hope you all had good weekends. What was I doing over the weekend? Resting, resting actually. So it's really good to be back on the show today to discuss again something of benefit to us and to learn from yourselves. We can reflect together on a few things. And just in case this is your first time of listening to us, this is the Roadmap MBA platform. We are all privileged. Personally, I'm privileged to grace this stage. The platform, the company, the startup was founded by Steve Pugh, who happens to be, in my very good explanation, a great man. Really, I was going through his book today, and I couldn't imagine the repository of knowledge he has, that he's been able to put together in that book. Really, and this is the book. Just in case you're wondering, this is the book. It's the Roadmap MBA book. And what's Roadmap MBA? It's actually a UK-based startup, a platform for business education, really, for career professionals, for startups, for businesses, young and old. Anybody who does anything around business would want to be part of this program. And you can easily be part of this by just checking up on the website, roadmapmba.com, and then subscribing to the guest list. You would receive one of this. And honestly, I was going through this today, and I found that if you are about to start a business or start a company, please don't do that until you've seen this book, honestly. Like, there were very, very hands-on, stuff in here, with worksheets, questions, kind of very interesting stuff, really. I don't want to let it all out of the bag, but just request for one. I think it's guest list at roadmapmba.com. And just send an email there and subscribe and join this epoch-making venture. To be honest, I'm super, super happy to be part of this show as one of the guest presenters. Steve also presents here. Ashley, who's also a very good friend of mine, presents here as well. And I'm aware that the list is growing. Very soon we'll see more people, more global minds gracing the stage. And then the goal is simple. The goal is simple. We need to reach out to at least 5 billion people worldwide. And, Steve is a social, is someone who believes so much in social justice. He wants to really impact the world. And this is his own initiative. And we are so proud to support him in this mission to help people around the world build a better lives for themselves. So that's it. Get in to roadmapmba.com, check out what we have there, subscribe, and then get a copy of the course, and then follow. A lot of new things are going to happen soon. I'm aware the website is coming up really hot, the app. I think this is just the best time if you really want to come on board, because we'll be scaling really, really fast and so soon. So enough of the intro. So today, really interesting day, honestly. As you can see, I'm dressed like someone. I'm sure if you really look very well, you would imagine who I'm dressed like. Today is really an important day for us in the UK anyways. We have a new prime minister today. And if you look very closely, you will know that Rishi is always rolling off his sleeves. And I think in any case, today he really needs to roll off his sleeves, and because there's a lot of work to be done in our economy. So it's a very interesting day. And coincidentally, we're going to be reflecting on something that has really taken in kind of a turn within the last few weeks, based on the happenings within and without, right? We'll be reflecting on the falling or let's say the fortunes of the sterling, of our currency, right? And then we'll be trying to reflect on what are the implications for businesses, right? If you're a business leader, a business owner, if you're a customer, a client, if you're a career professional, you're a student, what's the implication of the falling sterling or the declining or the instability around the sterling? What's the implication for you? So basically, it's just in the spirit of mindfulness, we want to really engage with this topic that I think is really on the hot burner right now. Is at the center of our political economy, really. Again, a lot of questions are coming out recently. In fact, if you've listened to Sky News, BBC recently, there is a recurring question that keeps asking, what is the place of the markets in politics? So again, so many questions. We'll try and reflect on a few of them today. But like I said, we'll be looking at the declining sterling, pound sterling, and what are the implications for us as business people, for those existing businesses, new businesses that are about to kick off, career professionals. What are the implications for us? So just to make sense of this, really, I thought it was going to be important to really understand really how far we have come, within as a country in terms of our performance. So when you say something is falling, in comparison to what, right? I think that's usually the first question. You say something is bad or is down or is going up in comparison to what? There has to be benchmarks, right? To be able to say for certain, excuse me. There has to be benchmarks for you to be able to say for certain how good something is or how bad it is, right? So I thought that the first thing to do was to quickly look through, kind of go down, down a little bit of history within the last 2 years to see how far we have come, how far the sterling has come, and kind of draw a kind of a trend analysis that gives us a good picture, right, of where we are, where the currency is, and then make sense of what the stressors have been or the drivers of this fluctuation or decline, if you will, of the pound sterling. And to do that, what I did first was to look at, going back within the last 18 months, to see how far have we gone, and where are we? Is there really, there could be this buzz around the decline of the pound sterling. Is it really, really down like that? Is this something, to cause us to worry, or is this something we could easily, just bounce out of, without really stressing on? So to talk about this, what I did first was to look at, to compare the pound sterling with the US dollar first, within the last 17 months, to see where this, again, there could be better graphs than this, but again, this was just in the moment, right? And very quick analysis to really allow us reflect, right? Within the last 18 months or 17 months, as it were, you can see here that in May 2021, and I picked May because we had a peak here where I think the dollar to the sterling to the dollar was at one of its highest. It was at about 1.41, at that time. And since that time till this time, you can see the decline. In May 2021, we had 100 pounds was $142, and in October, just a few days ago, it is $112. Clearly, you can see that there's been a decline of about 20% between this, within this 18 months or 17 months in question. So this is on one hand, we just keep this data we're trying to analyze. We will come back to them. Another quick statistics here, because when you look at, if you're saying the dollar to the sterling is falling against the dollar, it was also good to look at other currencies, other major currencies within our region as well. So the euro really, and the euro to the dollar, to see if there is something, if the drivers are regional or they are really specific to the UK in essence. And then when you look at the euro to the dollar, clearly there's also been a decline, right, of about 17%. Not as bad as it is to the sterling, right? Not as bad as it is to the sterling, but there was also a decline. And then I also felt to look at the sterling to the euro. So comparing within the region, right, to see if there has been any major changes. And what was really interesting was that there was very, very small change. Really, it's declined, no doubt, but really, if you will, negligible. This could be made up within a day or two. With some positive confidence in the market, this can be made up, right? So quite negligible. And then what this, started leading me to ask was, what really was, why is the dollar, why is the pounds declining with respect to the dollar? The euro is also declining with respect to the dollar. So the dollar is maintaining some strength, apparently, but comparing within the region, the pound sterling and the euro have not really changed so much, in comparison to themselves. And then, clearly looking at what are the stressors really, what are the drivers for this change or this decline. It will be really quite easy to look at the global shocks or the global effect or the global happenings really within the global markets. And three key things, I usually call them the trinity of events, really. Three key things I usually call, that have affected the global markets, especially with respect to trade, across the globe, and especially in the UK, is what one is, of course, COVID. We all know what the impact of COVID, on the markets, the restrictions, supply chain, and all that. And then there was Brexit as well, which meant that we had to reimagine how we engage the world. Trade barriers had to come in. A lot of, in fact, one of the major drivers within Brexit was, of course, workforce. The workforce that usually was very easily available to the UK market was no longer there from Europe. And that was a huge, huge stressor. In fact, in October of 2021, there was a record number of vacancies in the UK, 1 million vacancies that were not filled in October last year. That was a record number. And then, you don't need to look so far to understand where those were coming from. People needed to get new visas, if you will, mostly from Europe, to be able to stay in the UK and work. So that's on one hand. And then the third thing, which I usually coin as the trinity of events, is usually climate change, which I would say has dovetailed into the energy crisis now, that has been really, really given, exacerbated by the war in Ukraine. So these are key global shocks that, one could say has impacted the global market, at least up until the beginning of this year. And then when we look at it a little bit closer, right? What are the key things that we can see, that have impacted this, that has caused this decline within this year, at least within this year. And the key thing, which we all know, is the war in Ukraine. Clearly, while I was reflecting for this session, I thought to think about the how has this really affected the UK, for instance? You know, Ukraine is important to the world in many respects. I can imagine this, the shocks in places like Africa, where, of course, most of the grains and wheats come from Ukraine. The UK does business definitely with Ukraine in terms of food supplies, but again, not in the extent that other parts of the world rely on Ukraine. And then, so in terms of the food supply, like I said, Ukraine is the world's biggest exporter of wheat, and this is something that has really, really impacted. So with the whole supply chain impacted, even production, manufacturing, and all those basic cultivating of the product over there have been impacted by the war, and this has also impeded, the supply of food across the world. And then when of course, once a major, interestingly, the interesting statistics there is that 15% of the global trade of corn is contributed by Ukraine. 15%. That tells you, the magnanimity, or sorry, the impact really of the war, on the food supply chain, and then the UK also does, import some of its grain, but not in so much numbers. But the point I'm trying to make is that with these global shocks, right, impacting the global market. So if, for instance, a typical example is, other cereals or other confectionaries or other things we import from maybe Germany, Canada. Let's say beer, for instance. Germany, the UK imports beer from Germany, from Netherlands, from France, from Belgium, right? And then with the growing shocks within that market, it means that the demand becomes high on those other markets that are available, and then what happens is the prices certainly will go up. And then another clear thing is around the energy, which we all know, very clearly around Russia's impact on the market. Russia, we all know, is, I think, the third largest exporter of crude. 12% of the world's crude oil comes from Russia. So you can see, on one hand, a major player in energy, in oil, and a major player in food, in cereals, wheat. Most of the bread we make comes from wheat, with the corn and everything from Ukraine. So, and you can now see clearly where the whole food crisis, global food crisis that is being talked about comes from, right? And then this whole thing comes together to impact on the local populace. And then it means that, people are no longer able to get as much as they would usually get with the income available to them, right? So I'm giving all this preamble to say these are things that impact generally on the sterling, because we eventually do business with other countries, right? And we are a part of the world. In fact, a typical example is the energy, for instance. Energy today, oil prices are denominated in US dollar, right? Which means that if we have to buy dollar as a country from the UK, we have to convert into US dollar, right? And we need to continue to maintain our exports, our GDP, to be able to pay for those external importations that we do. And so you can see very clearly the stressors on the pounds, coming from the energy, from oil, and then from the global food crisis. And then coming back home, which is what I consider the most critical part of the drivers, has been, the recent political economy really in the UK. And when I started today, I was talking about a key question that people are asking now to say, what really is the role of the markets in politics? Are we beginning to see a more pronounced role of the markets? When we're talking about market, we're talking about the stock market, the bond market. In the UK, it's called the gilt market. Are we beginning to see a more pronounced role of the markets in our politics, right? If you've been following closely on our political economy, and I would usually advise everyone, if you have anything to do with the UK, you stay in the UK, you do business here, it's very important to keep abreast of what's happening within our economy, especially within the polity, right? Just so that you're well prepared, to make decisions that impact you as well. So within the last few weeks, we've had a key word that I've heard over I can't say how many times. Each time I turn my TV or my radio or go on the internet, I hear stability. I hear stability all the time. And I hear difficult decisions. This is something that I've heard so much within the UK. And, it just boils to tell you that there is some form of political changes happening within our economy, which ordinarily we have begun to see it impact the markets, and thereby impacting our currency, in some ways. And I'll try to explain what the real relationship really, because sometimes it's kind of difficult to understand what the relationship is with 10 Downing Street and the fall in the sterling, right, or the decline in the sterling. People really want to know, how does that really impact anything? We know that sometime in September, when the mini budget was brought out, that same day, in fact, it was on a Friday. By Monday, when the markets opened, there was a huge dip in the currency, right? Why is that so? What really must have caused it? What happened? This is the kind of question. This is the kind of we want to really, reflect on, to say, how does what happened in politics, usually in the past, our experience of politics or of government, is that the governments do their business, the central bank does their business. The central bank does the rates, monitoring, ensuring, fixing of rates, and ensuring all of that. So what has happened? Has the power shifted really from the central bank to the markets? That's a question. I can't answer it today, and I'm sorry, but I will try to reflect on it to see if we can make sense of what are those drivers really within the market that ensures that things can really go out of the hands of the politicians. Because literally, the market determined the fate of number 10, right? Because I would say this, if after the mini budget, the market hadn't responded the way it responded, maybe we wouldn't have had a change of government by now. That's a kind of a hypothesis. But again, it's a kind of a sure hypothesis to say something happened and then something happened. Can we tie them together? And then why is this market so strong, right? Why is the market so strong, really? Why is the market so strong? And a key thing that came out of the conversations I've been seeing on, I've been trying to follow these engagements really strong, to listen to people, the former deputy governor of the Central Bank of England was on interview sometime on Sky News, and then he made a comment which I felt was really, really important, that he's been in the Treasury for many years, and in his words, one of the key people that they always manage very closely are the people they call treasurers. And he in his own understanding, he felt that one of the key things that happened here was the the policies weren't totally, while the policies were kind of new though, they were quite different policies from what has been, tax cuts, tax cuts more. He felt that there was a need to have the market ready for this kind of information, right? And a key thing that I picked out from the conversations was that, in finance or in economics, there's usually two legs of everything, right? If there's a debit, there has to be what? A credit, right? And then if you debit an account, you must credit the account. Or if you want to spend, you must tell, get where you're getting the money from. And that's what the market seemed not to be clear about, about how the borrowings, how the mini budget will be funded. Basically, the market wasn't clear about that. And so there was a kind of a lack of confidence, if you ask me, it was a confidence vote, right? So we've moved away from Parliament doing a confidence vote to the market doing a confidence vote, which was very interesting, really, because my understanding of the markets was that in the past, when governments do fiscal policies and they don't work, the central bank cleans up immediately. And most times you don't even get to feel them in the market. But this time around, what was different was that the response from the market was swift. The confidence vote was swift and action had to be taken. And, so the real question was, why was the central bank's action not enough to assuage the market? Because the central bank did something, right? They raised interest immediately just to ensure that they're able to balance the inflation that was already going high, and then see how to stabilize the currency. But there was some underlying factor, which I think it would be good. And that was the reason why I talked a lot about the global shocks. Let's go back a little bit, some 18 months, 20 months, a year, 2 years ago, when COVID started. Remember, at the time COVID started, we, as a country, we needed to shore up our preparation, our response to COVID. A lot of monies were spent. People were not working. People were being paid follow schemes. People were being paid, a lot of bailouts. The national rail were bailed out. A lot of bailouts were given. A key question to ask is, where did these monies all come from? Right? Where did these monies all come from? And this is really interesting because one of the key things that came out, and I'll come back to my line of thought, one of the key things that came out as part of my reflection on this was the fact that most of the things that happen on the global stage is denominated in US dollars, means that we have to always match our own engagements with the dollars. Right? We have to match with the dollars. So we don't have the leverage to just go and print money and use. We have to generate, there has to be a value stream of the money that we're using. So it's either the money we worked for, or we're borrowing, essentially. So in essence, most of the monies that we use for the follow schemes, for all those payments, all those stuff, to see us legitimate reasons, right? To get us the vaccines, to get us all the things we needed to get out of COVID, were literally borrowed funds. So which meant that our borrowing had done what? Had gone up. And a good thing to remind ourselves here is that the government usually would, most of our lenders are international, right? So they're also watching. And when you're lending to someone, you're also watching. It's just like when I go to take a mortgage. If I have a high risk profile, the interest rate of that mortgage will go up, of the lending will go up, because the reason is that the lender is doing what? Is taking a higher risk to give me money. So most of our lenders, are lenders to government. We're watching the scenario. Mind you, we already had a high portfolio. It was not the worst in Europe, though. In terms of our debt to GDP. The UK stands about 85 to 90% at the moment. There are countries that are in 100 and something. I think Italy is 130%. Some other countries are really, high. But so we're not in an alarming stage at the moment, so to say. So 85 to 90% is not alarming, but what it is high, no doubt, right? And so when you look at that, we already had a high debt, and then there was now a pronouncement that we were going to increase that debt by another 45 billion pounds, right? And there was no corresponding explanation, even though the explanation may have been there in the books, but it wasn't communicated out, right? To say, this is the way we're going to do what? To fund this excess. Now, what happened immediately was that, first and foremost, our borrowers began to be jittery. Our lenders, began to be jittery to say, oh, this is becoming high risk. In fact, I think the ratings immediately changed to, this is becoming high risk. Immediately that was done, the cost of borrowing to the UK went up. And once the cost of borrowing goes up, what happens is that if we have to go borrow again, we're going to be borrowing at a higher cost. And then it impacted immediately our, the minds of the investors, both local and international. So people began to say, how are we going to pay for this? What's going to happen? And the worst thing that can happen in the economy is speculations. What that leads to is that it leads to people beginning to take panic moves, panic measures. So people begin to dump their gilts, their bonds, investors or companies begin to re-hedge their funds. So measures begin to happen. And once these begin to happen, what happened there is that in terms of the bonds, of course, government have bonds, right? When this uncertainty begins to happen, people begin to dump in their bonds, right? And then the yields begin to go up. And once that begins to happen, the prices go down, people begin, so what it's just like a chain of events, and then it begins to impact ordinarily on the pounds. So this is a very good just trying to explain and reflect on how the actions on number 10 impacted the market and how the market has become really, really, topical in what happens in politics. In the past, we usually would say they're separate factors. Politics is on its own, the markets on their own, the economists on their own. They make their, and stuff like that. But it's no longer the case. There is a very fine line between both of them now. The whole political economy and how things. And just to tell you about how the market perceives, the confidence or how the market perceives things. Just within yesterday and today, there's been an upward trend. In fact, the market has ignited a trend upwards. So as at the time I was doing this yesterday, the pound was on 112, 100, 1.12, 1 to 1.12 to the dollar. But at the moment, it's on 1.13. It's gained about 0.40% over the night, just over the night. In fact, FTSE 100 index grew by 50% just today. So clearly, you can see what the market does. It's looking out for confidence. It needs confidence. And what the deputy governor of the Central Bank of England did say on that show was, a good way to do it would have been to engage the market on a kind of a short to mid-term engagement on kind of explaining your fiscal policies so they can be ready when these things come. And in business, really, this is exactly what they call change management, right? You want to bring a big initiative on in your company to bear. You need to be careful how you bring it out. Because no doubt these were good ideas. Let's take a quick look at the mini budget. Really, there was the NI reversal, which we all want, don't we? Come on. There was the basic rate of basic tax rate, which was going to drop from 20% to 19%. There was of course, a lot of people will argue that the upper range of the 45p that was removed shouldn't have been, there was that argument. But again, there is the energy price cap, which was also put in there. There is the cushion of £400 that goes to virtually every home in the UK. There were a lot of good things. There was even something around ensuring that people fulfill their job search criteria to be able to qualify for universal credit. This was a good thing because, eventually the Prime Minister, the ex-Prime Minister, wanted us to grow. She wanted growth for the UK, right? But these were good ideas, no doubt, noble ideas, right? But again, the point is, a noble idea could also become an immediate bad idea if not well implemented, right? So the lessons from that, before we go into the implications, really, the lessons which from my engagements with, with interviews and with experts within the sector, was that if there were regular engagements with the market, with the key players in the market, right, through some form of fiscal policy engagements, right, it would have been able to prepare the market and then probably release these in bits in order to test the market before. And this is really important for business people, career people, to know that, in making big business decisions, it's important to understand the dynamics of the market. And I was going through Steve's this course book, where he was talking about the strategy, the Ansoff matrix he called it the one jump, not two. Yeah, one jump, not two. And what that simply did, I was just going through that today, was talking about how you position in the market. If you're trying to go into a new market and you're trying to develop a new product at the same time, that could be disastrous. And the simple reason is that you're taking too much risk at the same time, right? You're taking too much risk at the same time. So he's in his proposition, and this was done by, actually initially proposed by Igor Ansoff, right? Yeah, Ansoff, some time ago in his strategy document, where he said, you have to go one step, minimize your risk, go with one known and one unknown, just so that you are able to manage the unknown while leveraging on the known, right? Clearly, this is a lesson for business people, right? When you're trying to bring up something new, trying to bring out a new product. Clearly, the XPM was trying to bring out a new product for UK Limited, right? And clearly there was a new product and maybe a new product and a new market, because she was new in the market, honestly, And so it was like taking too much of the risk at the same time. Good ideas, but wrong timing, so to say. So that's the lesson in there. And then that conversation still keeps going. The relationship between, if you're a researcher, if you're a student, you may want to do a little bit of research into the relationship between the markets and the political economy. As the market develop more powers than it used to have in the past. So let's look at quickly, why should I really bother about these things? Why should I worry about the falling pound sterling? Why should I worry? Why should it bother me, really? Is there anything in there that impacts me as a business person, owner of a small business, or as a career professional looking to navigate through my career ladder? What's there? Why should I worry about this? I earn so much money anyway, so I can spend my way through. Could that be it? So just to reflect on a few things that we can look at and to say, what does this mean for you and your finances, right? So number one is that definitely there is going to be higher prices of goods and services, right? And the reasons are simple. A number of products that we use are imported. Of course, we don't produce everything we do. We export a few, we import a few. In fact, that's how we balance our GDP and stuff like that. So we import a number of products into the country, and most of these products, depending on where they're coming from, means that with our falling currency, means that we have to spend more. So a typical example would be when we talked about the dollar. So in May last year, you could use £100 to buy something worth $142, right? But as at October, as at this time, what you were able to buy with £142, £100, what $142 in May last year is now worth $112. So which means that there is, and this business people who import these goods will definitely pass the price hike across to the customers, which is you and I. So definitely there's going to be a higher higher prices, which eventually leads to the whole cost of living crisis. Every now and then you hear of strike actions. What are people complaining about? People are saying there is inflation. Our monies are no longer enough for us. We can't buy food. In fact, in the UK at the moment, there's a growing amount of food banks where people are having to go to solicit for food to eat because of this growing food crisis. And someone could just ask, just as an aside, maybe anyone who's listening who's trying to understand this whole concept of inflation, it's very simple. Where there is too much money chasing too few goods, and there are different reasons why that could happen. It could be that we're not importing enough for us, that enough food for our people, or we're not producing enough. There are different causes of inflation, really. But in our own case, it's more of a chain. Right? When we have so much money, so to say, people's disposable income have grown. They have quite a bit of money, and there is not so much in terms of supplies, in terms of the goods. There's much demand, but there's not so much around the supply, right? What happens is that prices go up. So demand is more, people have more money. In fact, that's exactly what the market was scared about, that with the tax cuts as well, people would have more monies in their pockets, right? There will be much monies, buying power, but was it commensurate with the supply on the ground in terms of the the goods and services, So there was much money, meaning that, again, that could trigger some form of inflation, right? And then leading to the government, the central bank, trying to regulate it by increasing interest rates so that people can borrow more, and then reducing the amount of money, or fiat money in the circulation, just trying to balance it out, right? And so once these inflations happen so there's definitely going to be higher prices, which also could impact on businesses. Because what happens is that with inflation going up, right, the central bank has increased, or is increasing, as at September, it had gone up to 2.25, and there is a prediction that it would go up to 6% next year, right? And what that simply means is the central bank increases the interest rate, and then people, just so that they can discourage, so to say, and it's not good for the economy. And they kept saying it, that they don't want to do this, but they're constrained to do it because they have a mandate to keep inflation below a certain limit. I think it's 2% or so, or less. They have a mandate to keep inflation below that limit. So once it keeps going up, if they increase interest rates, borrowing, right? Once interest rates are increased, it means that people will borrow less. People will borrow less, and then they can reduce the amount of people, the amount in circulation, right? And that goes to tell you that once there is borrowing reduces, that impacts capital issues for businesses. So this is a clear-cut impact on implication on our businesses. So businesses will usually rely on maybe revolving lines of facilities, to ensure that their businesses continue, will be stressed at the moment, because what has happened is that the cost of borrowing will go up, and the trend already says that it will continue to go up. That doesn't portend so well for businesses, right? Because businesses that usually rely on borrowings for their day-to-day business, would be impacted by this interest rates rise and this inflation, and you can see the chain, it just goes round and round. And something as simple as the beer that we drink on every Friday, we go to the pub, right? I saw an article that stated that this is also going to be impacted, because irrespective of the fact that we have a number of beer manufacturing companies in the UK, we import over 1 billion kg of beer every year. That's a lot. In fact, I was discussing with someone the other day to say, in some other climes, beer could be a luxury, but it's not a luxury here, because we use it to relax. Every Friday we're at the pubs. We need to relax, and but clearly, we used to buy a pint, I think £6 or so, a pint of beer, most likely going to go up. And that means really hitting really hard, really, close to home, because almost everybody, let's say a huge percentage of the population, has at some time goes into the pub in the UK to have a pint. Right? For us, it's part of, in fact, some people have their business meetings in the pubs, right? So this is something that a direct implication for ourselves, in essence. Another very interesting thing, I've seen a comment there on LinkedIn, someone's talking about mortgage. In fact, that's the next thing I was going to talk about. The relationship between the inflation, right, the falling pounds, and the higher mortgage repayments. So how does it relate, really? How does it relate? So something very important, and I think it's good to also understand the different kinds of mortgage we have. So the UK market, the UK mortgage market is a very trending market. Is a trending market, and it has helped a lot of people to own houses, and pay over time. And it's simple. Mortgage just simply means that you borrow to buy a house, a property, right? Either for personal use or for rentage or whatever, but you're paying back over a period. You've agreed a certain amount of interest with the lender, and then you're paying back over a period, right? And there are different kinds of mortgage we have. Of course, there are the fixed mortgages, which usually are probably at the beginning of the mortgage period, where maybe the first 2 years, the first 3 years, depending on your negotiations or the package, the mortgage deal you have with your lender, the fixed period, there are the standard variables, there are the trackers, but the ones that are really impacted by the interest rates really are the variable ones. The variable ones, usually the standard variable, the tracker, those ones are usually impacted by by the interest rates. And let me just give you a little explanation of how these things work. So the central bank increased interest from, it was previously 1.75. They call it, it's called the monetary policy rate, right? From 1.75 to 2.25. And another review is going to happen in a fortnight, and there's every tendency is going to go up. Now, what happens is that based on the MPR, or the monetary policy rate that the central bank has declared or has fixed, lenders will place their own lending, lending at a certain percentage based off on the basic rate that has been given by the central bank. And the difference between the rate of the central bank and what the eventual lender puts is usually called a spread, right? And that's how banks, not only banks, really, lenders, are able to get into business. And that spread is determined by a number of factors, right? The market condition, competition, a lot of things come into play in fixing that spread that ensures that companies, lenders are able to lend to to people who need this. So if you have gotten a mortgage, for instance, and you have been given a variable rate or a tracker rate, what it means is that it tracks the so let me just quickly explain the different types of, like I said, the fixed mortgage has a fixed interest over a period of time. So within that period, you don't worry about what happens with the market, with the interest rates, right? Now, the tracker, there is what the one they call the tracker. The tracker means that it tracks the interest rate. It could either go up or it could go down, right? It could go up, it could go down. So if the interest rate you have taken up on, or you've signed up with your lender, is 5%, for instance, and it says that you're tracking, so maybe what it says is that you're tracking 2% on the interest rate. So if the interest rate is placed at 3%, you'll be paying if you agree 5% and the interest rate is going at 3%, if you're tracking, then you are paying the difference. So each time you are paying the difference, either higher or lower, right? So you're tracking, which, they're different depending on the need for the mortgage. That could be a good kind of mortgage to negotiate for with your lenders. There is a standard variable as well that, which also kind of follows the track, the interest rate, but to a large extent, you are at the mercy of the lender, with the standard variable. And then there's also the discount, which comes at a clear discount. You're giving a discount on what you're going to pay, and you can only pay so there are different kinds. There's also the capped rate, where it says you can only pay to a certain amount of rate, within the mortgage. So depending on what you have, but the people who are mostly impacted at the moment are the ones on the variable rates. And at the moment, approximately 20% of mortgages in the UK are on that variable rates. So which means that with the increase of interest rate in September, people's monthly premium would definitely go up, mostly around the 20% of people who are on this variable rates. So you see, people are now becoming anxious. People's rates could go up as much as, in fact, I saw a chart, and it showed that people could actually be paying up to £500 more than they pay monthly. And that's a lot of money for people to really, really worry about. So what do you do if you're still thinking of getting a mortgage at the moment? What do you do if you are already on the system? I think it would be worth having a conversation with your lender, really. If you're about to go into the pool, to get a new mortgage, it's important to understand the different kinds of mortgages available and what your need is for the mortgage. Very important. Understand, and that goes to saying you need to discuss really with your lenders to be able to understand the best kind of mortgage to avail to avail you. So you need to pay attention to the terms and conditions of the mortgage. Now, another key implication is we're going into winter. Even though we already have a price cap by the government, costing the government huge sums of money, we have the government subsidizing our bills by up to £400 between now and February, March next year. That's still, that's still quite on the minimum, because the market is still very, very, what's the word now? Volatile. That's the word, right? The energy market is still very, very, very volatile. And that important thing I mentioned was that oil trade is denominated in the US dollar. So what that means is that we need to continue to do exchange with our pounds to buy the oil, which also puts pressure on the pounds, right? So that again, if we see that oil prices are coming down at the moment. Oil prices are coming down. When Russia invaded Ukraine in March, we had a very steep increase in the price of oil, and that's because of the shocks it created in the global supply, right? And when prices of oil goes up, it definitely impacts the energy prices within the UK, definitely. And when these big energy manufacturers suck up this cost, they will definitely pass it down onto, and that could now mean that there could be more conversations. And from what we've heard in the reversal of the mini budget after April, is it April or March? After April or March next year, the support from the government will only be targeted at the vulnerable. So what that means is that people will still be impacted, in some way. So it's important for us to begin to look at things like, how do we improve our energy within our spaces? How do we improve our our energies within our offices, our houses and stuff like that? Do we need to go for space heaters? I saw something online the other day, a very interesting gadget, that heats up the room really fast, other than using the gas and stuff like that. Do we need to do all that? So those questions we need to answer. Another quick one, and I'm rounding off now, is with the declining sterling comes the cost of travel outside of the country. In fact, I was reading an article on the Financial Times, I think, and this also has its upside, really. So traveling abroad becomes more expensive, because if you have holidays normally where you would have spent £500, you may need to spend more to be able to meet your travel needs and do things you need to do. But on the flip side, tourists who want to come into the country will spend less, when they come into the country. So, which means that this is a good time for tourists to come into the country for their holidays and stuff like that. So if you're in the hospitality industry, you may want to target this period to drive some targeted promotions, some targeted business adverts, targeting people, especially within Europe, really, or even the US, because that's where the benefit will come more, because the dollar to the pounds has really declined, hugely to the dollars, and people with USD would get more value for their money than they would have gotten 18 months ago, like we put up here. So you may want to begin to target your audience in the US, in the Americas, to see how that impacts your business. And again, finally, another implication means that with the declining sterling, we get to have more sales from our companies in the UK. So companies, outside of the UK will want to buy bulk stocks at the moment, because it's cheaper. It's cheaper to buy things from our country, our companies here. So if there is a company in the UK, outside of the UK, maybe in the US, that usually buys yearly stuff or buys monthly. They may want to buy stock of a year just because they want to leverage the exchange rate at the moment. What that means is that we get to do more in terms of our turnover, but it doesn't so much tell about the value we eventually get. But again, it could be a good way to do what? To sell more goods, to really grill your economies of scale, get more things out, and then watch and see how the market goes. Because once you've built that relationship with your customers, even though you've not made so much money really, you will be in a better position to continue that business relationship when the pound bounces back, which I believe so much is going to bounce back. So basically, these are just a few reflections on what we think that the impact of the dollar, of the declining sterling is on our businesses, on the markets, on individuals, and how we can carry on. But there's a good news really. With the happenings at number 10 this evening, the markets are already responding. The markets are responding in very good light, and we're hopeful that the trend will continue upwards, and we'll have a rebound of the pound. But I must put this there: whatever expectations we have to limit them, because for us to go back to our pre-COVID, as it were, public borrowing, we need to really do a lot to go back to that level, really. And as much as our borrowing is where it is, it still definitely has a direct impact on how far the pound sterling can rebound. But in earnest, there is a lot we can do. I think it's important for businesses to understand some of these nuances around the markets, the relationships between the markets and the politics, and then pay attention to what happens in politics, and don't say, oh, it's just I'm not so much of a politician, because in developing your strategies, whether short term, long term, in how you become better, how you're able to maneuver the market, you need to take into cognizance some of these tips, some of these relationships, some of these things that happen as a result of what happens in politics, to be able to plan and have a competitive advantage, stay ahead of your peers while out there in the market. So thank you very much for reflecting with me. Sorry, I've not been able to respond to your chats. And thank you so much for all those who came in to drop me the word. It's been a very interesting conversation, I think, just reflecting on what has been happening within the past few weeks. But we are very hopeful. We are a resilient people in the UK, definitely. And we know that the pound is going to rebound, but until it does, we need to stay safe. We need to stay aware. We need to stay informed on how we can navigate. Thank you very much, and see you next time.